Today, some hard facts about the Australian economy. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. Today, I want to take you through some of the data released by the ABS, which provides an overview of the Australian economy in the years 2018 to 19. And they said that the Australian economy expanded by 1.9% in chain volume terms in 2018-19, and that's the 28th consecutive year of economic growth. Real net national disposable income grew 3.3%, reflecting the strength in the terms of trade, which increased 5.6% in 2018-19, following an increase of 1.9% in the previous year. Labour productivity in the market sector fell 0.2%, and the household savings ratio fell to 3%. We're going to look now specifically at a series of charts which really tell the story of what's going on. So firstly, let's look at the Australian economy in terms of GDP and GDP per capita. The Australian gross domestic product grew by 1.9% in 2018-19, and that is unchanged from the annualised growth published in the June quarter 2019 national accounts. But GDP per capita growth eased to 0.3%, the lowest annual rate of growth since 2009-10. Next, we look at domestic final demand drivers. We find that domestic final demand contributed 1.5 percentage points to GDP growth. Household and government consumption contributed 1.1 and 0.8 percentage points respectively, while total gross fixed capital formation detracted 0.3 percentage points. Net exports contributed 0.8 percentage points, which was driven by exports of goods and services. Next, we look at household consumption growth, which is the weakest in 6 years. The household final consumption volume measure recorded growth of 1.9% in chain volume terms in 2018-19, and spending on essential items continued to grow modestly while discretionary spending slowed. Next, we look at the household savings ratio, which declined further. The ratio is another key aggregate in the national accounts, and household savings cannot be measured directly. It's calculated by deducting household final consumption expenditure from household net disposable income. The household saving ratios fell to 3% in 2018-19. That's the lowest annual saving rate in 11 years. The fall in household net savings can be attributed to the subdued rise in household final consumption expenditure outpacing soft growth in gross disposable income. And gross disposable income was impacted by a substantial increase in income tax, which was paid. Next, we look at household loan liabilities. It's the softest in over 25 years. Household land and dwelling assets relative to loan ratios shows the value of land and dwellings held by households, and it was 2.9 times the value of households borrowing in 2018-19, decreasing from 3.1 in 2017-18. The value of land and dwellings owned by households fell 3.8% or $256 billion to $6.67 trillion, and that's the first decrease since 2011-12, reflecting the declining residential property prices through the year. And this was driven by falls in the value of land, down $326 billion, while the growth rate of the value of dwellings at 3.1% was the softest since 2011-12. The tighter lending environment and weak housing markets in 2018-19 also impacted the demand for loans by households. Household loan liabilities grew 3.8% or $85.7 billion, and that's the softest growth rate since 1991-92. Next, household living standards. They softened due to the slowing housing market. Household income and wealth, current prices, living standards and economic well-being are supported by wealth as well as income. The growth rate of gross disposable income has slowed in recent years. However, households reap gains and incur losses from holding assets such as land, dwellings, equities, and accumulated savings, which also bears on consumption patterns. Household gross disposable income plus other changes in real net worth decreased $361 billion or 27.4% in 2018-19. Gross disposable income grew modestly at 2.8% to $1.2 trillion, while final consumption expenditure grew 3.7% to $1.1 trillion. Real holding gains on financial assets were $140.2 billion and driven by increases in superannuation assets. However, this growth was offset by $457 billion of real holding losses on land, reflecting decreasing residential property prices through the year. Next, we look at mining investment, which shifted away from non-dwelling construction to machinery and equipment purchases. And they showed that non-dwelling construction as a proportion of total mining investment has fallen for the third consecutive year. This reflects the transition of large LNG projects from construction into the production phase. And over the same period, the contribution of machinery and equipment investment has increased from 8.9% to 19.9%. And this is driven by investment in autonomous machinery as existing projects seek to enhance productive capacity. Investment in mining intellectual property products increased to 10% of mining investment in 2018 and 19, reflecting increased mineral and petroleum exploration driven by global demand for resources. Next, mining net capital stock declined for the first time. And this shows the net capital stock of mining in terms of volume measures. The net capital stock of the mining industry declined by 0.2% in 2018-19, and this was driven by falling investments in non-dwelling construction and research and development over the last 5 years as facilities have progressively entered into production. The Australian economy has changed dramatically over the past 20 years, as reflected in changes in the contribution to gross value added. In 2018-19, the industries with the largest share of current price gross value added at basic prices were mining, 10.2%, financial and insurance services, 9.3%, and construction at 8%. Mining recorded growth of 6.1% in 2018-19, driven by oil and gas extraction. Continued strength in oil and gas extraction is due to new sites coming online during the year, and the transition of these facilities from construction into production has had downstream impacts on the construction industry. Construction gross value added fell 3.4%, driven by heavy and civil engineering construction, reflecting a decline in work on the development of LNG facilities. Financial and insurance services rose 2% in 2018-19, and the increase was driven by other financial services and insurance services due to an increase in funds under management, while finance rose due to modest growth in loan and deposit balances. Healthcare and social assistance rose 7.4% in 2018-19, reflecting strong public expenditure in the health industry. Next, compensation of employees' share of total factor income. Well, wages share of total factor income for 2018-19 of employees fell to 52.1%, recording its lowest level in 10 years. Profits share, based on gross operating surpluses of corporations, of total factor income was 28.7% in 2018-19. This is slightly below the peak of 29% seen in 2008-9. Mining was the major contributor to the rise in profit share of total factor income, and mining profits rose 26.4% in 2018-19 due to increased production volumes of LNG, coupled with high commodity prices. The profit share measure should not be interpreted as a direct measure of profitability, for which it is necessary to relate profits to the level of capital assets employed. Next, we look at the record level of mining exports, because the exports relative to GDP in terms of current prices showed that mining commodity exports has overtaken the contribution of exports of all other goods and services relative to GDP for the first time in history. The increased value of exports in mining commodities at 26.3% in 2018-19 was driven by other mineral fuels, mineral ores, iron ore, and coal. The value of exports of non-mining goods and services rose a more moderate 7.8%, and the increase was driven by travel services, metals and metal manufacturing. And this growth was partly offset by a fall in exports of cereals. Next, we look at the market sector multi-factor productivity. Because productivity growth based on the hours worked by market factor fell 0.4% in 2018-19. That's the first decline since 2010-11. The market sector gross value added of 1.3% was the slowest output growth ever recorded for the market sector. By comparison, combined labour and capital inputs grew 1.6%, reflecting capital service growth of 1.8% and hours worked growth of 1.5%. Labour productivity fell 0.2% in 2018-19, the first recorded negative for the market sector aggregate. On a quality adjusted hours worked basis, it fell 0.7% and labour productivity fell 0.8%. The weaker growth on this basis reflects a positive contribution from changes to labour composition due to educational attainment and work experience. A common method of examining changes in productivity over an extended period involves identifying and dividing the data into productivity growth cycles, and new growth cycles have been added in the period of 2011-12 to 17-18. And now we look at the composition of national net saving shifts, because net savings by sector shows that savings increased by $14.9 billion in 18-19, recording a third consecutive year of growth. And the growth in 2018-19 was driven by a $12.3 billion increase in general government net savings and an $11.2 billion increase in non-financial corporations net savings. But offsetting this was a continued decline in household net savings, which decreased by $7.8 billion in 2018-19. Net savings of financial corporations remained relatively flat, with a decrease of $823 million. Over the 5-year period since 2014-15, the composition of sectors driving growth in national savings has shifted, with a continued decline in the household net savings position, offset by strong growth in general government net saving, and to a lesser extent, growth in non-financial and financial corporations net savings. Since 2014-15, household net savings have declined by $46.4 billion, and this gradual fall has been driven by strong growth in income taxes payable, combined with continued growth in household final consumption expenditure outweighing modest growth in primary income receivable, including compensation of employees and gross operating surpluses on ownership of dwellings. General government net savings has increased by $47.8 billion over the 5 years since 2014-15, and this growth has been driven by continued strength in income tax receivables from both households and corporations, outweighing growth in final consumption expenditure and other income payable. Okay. So that's all the jargon. Now let's understand what it means in simple terms. We know that household income is relatively flat. We know that households are spending a lot less. And we know that households are feeling less wealthy because the value of their properties have declined. We know that the overall economy has been supported by very strong exports, specifically of iron ore and LNG. And we know that the government has been supporting the economy in terms of infrastructure investments and also by continued savings. But I'd also make the point that households are paying more in income tax than ever before, and that is also another drag on households, but also supporting the overall economy. But I think this is a very troubling scorecard, because this shows that overall the economy is ill-balanced. The household sector is under severe pressure. One reason, of course, why households are being encouraged again to go out and spend money on property, which I think, as you know, is a bit of a fallacy. And we're not addressing the fundamental questions of income growth and productivity. And of course, we're also exposed because a lot of that income was generated by high iron ore prices, which are now coming off. This is an ill-balanced and ill-managed economy. But whilst the government may suggest they're excellent managers of the economy, these results suggest something else completely. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.